welcome to the deep dive. Today, we are tackling a subject that is it's always on the minds of Canadians. Housing.
It really is. And right now the market is in this strange kind of limbo.
Exactly.
Yeah.
It refuses to crash, but it doesn't seem to have the conviction to really take off either.
Well, it's an incredibly complicated picture. You've got this aggressive rate whiplash from the Bank of Canada. You've got a deliberate policy to slow down population growth. And then there's this, lingering uncertainty on the global trade front.
So that's our mission today, really. To get laser focused, we've dug into the latest October housing data from the Canadian Real Estate Association, CREA, and we want to figure out if this inflection point everyone's talking about, is it actually here?
Or are we just, getting a little ahead of ourselves? Because you have to look beyond the monthly headlines. It isn't just about what the Bank of Canada might do next. It's about these bigger structural forces, political global mirrors that are already shaping how people are thinking about 2026.
Okay, so let's start right there with the facts on the ground. The October numbers. At first glance, the sales figures look, modest. A 0.9% increase month over month.
Yeah, in a normal market, you'd just shrug at that. Trivial.
But not now.
Not now. I mean, think about the context. The labor market is soft. Interest rates are, frankly, punishing. So to see a rise at all, especially the sixth one in 7 months, that tells us something really important.
Which is what exactly?
It suggests that ordinary buyers, end users, not speculators, they finally passed a critical psychological threshold.
They've just accepted the new reality of rates.
They've accepted that rates aren't going back to 2%, so they're re-engaging with the market, but, out of necessity.
But let's keep it in perspective. Year over year, activity is still way down.
Oh, absolutely. This is not a market running on irrational exuberance.
Not at all.
This is a market moving forward with extreme caution.
Okay, let's talk supply, because that's where the stability story really starts to make sense. New supply actually went down 1.4% in October.
Right, so you have sales nudging up just a tiny bit and new listings thinning out.
Which means the sales to new listings ratio tightened.
It's our thermometer for market heat, right? It moved from 51.0% in September up to 52.2% in October.
That 1.2% jump. It sounds small, but you're saying it matters.
It matters a lot because the long-term average for a balanced market is 55%. So moving from 51 to over 52 means we're walking away from a buyer's market and stepping right back into balanced territory.
So sellers can breathe a little easier maybe, and buyers feel a bit more pressure.
That's the feeling on the ground. And the key is that this is happening while the economy isn't really rewarding risk. It's pure end-user demand rebuilding.
How do we know it's not just cash buyers, though? Speculators who are waiting for the bottom and are now jumping in.
That's a great question. And while, those buyers are always around, the cost of tearing in debt right now is just such a powerful disincentive for large-scale speculation.
So the sources are pretty clear on this.
Very clear. It's driven by people who have to move. A growing family, a new job. These are life decisions, not short-term bets on the market.
Okay, let's round out the data here with inventory and pricing. Total listings are holding steady, about 189,000. Almost exactly on the long-term average.
And that stability is what keeps the whole thing from, flying off the rails. The key metric here is months of inventory.
Right. How long it would take to sell everything currently listed.
And that held at 4.4 months for the fourth month in a row. That's the lowest it's been since January.
And the long-term norm for that is 5 months, correct?
It is. So we're oscillating in this really narrow, quiet band. We don't have the bidding frenzies of a 1-month supply, but we also don't have the distress of an 8-month supply.
And that often happens just before a real turn in the market.
It's often the quiet before the turn, yes.
And prices are reflecting that. The MLS Home Price Index, the HPI, it barely moved, up just 0.2% in the month.
Yeah, the monthly change isn't the real story, it's the annual decline. The year-over-year drop narrowed to just 3%. That's the smallest contraction we've seen since March.
So with a national average price at around $690,000, it feels like the worst of the downward adjustment is over.
It really does. It feels like we're sitting on a new psychological floor.
Okay, so the market's pulse is stabilizing. But let's pull the camera back and look at the bigger pressures holding it in check. This is segment 2, the broader economic frame.
And you have to start with the labor paradox. It defines everything about financial confidence right now. We saw those recent job numbers from StatCan, right? Up 60, 70,000 jobs.
Sounds great on paper.
On paper. But the pattern underneath is what's concerning.
A lot of part-time work.
A lot of part-time work. And overall unemployment is still stuck near 7%. That's a problem for a high-cost country like Canada.
Because part-time work doesn't get you a mortgage.
Exactly. I mean, the bank underwriter needs to see stable, predictable income. A few part-time gigs, even with wage gains around 4%, that helps you pay for groceries, but it doesn't give you the confidence to take on a massive mortgage.
So housing stability is fragile because job stability is fragile. Okay, let's look abroad. Our sources pointed to the USMCA 2026 review as a source of household risk.
This is where, politics and your mortgage planning really collide.
How so?
That review of the big trade deal, US, Mexico, Canada, it just creates deep uncertainty. Manufacturing, exports, especially in Ontario and Quebec, they rely on that stable access to the US.
But why does the average homebuyer care about trade talks in Washington?
Because it hits their job security directly. If you work for, say, a car parts maker in Southern Ontario and you see headlines about trade tensions, you put big financial decisions on hold.
You don't upgrade the house.
You don't. The perception of risk is enough to keep people cautious no matter what interest rates are doing.
And then there's the slowdown in population growth, which has been really sharp.
Oh, yeah. The caps on temporary residents had an immediate effect. You saw rent inflation start to cool off, vacancy rates ticked up a bit.
It took the pressure off.
It completely softened that intense urgency that was pushing renters into the ownership market, sometimes out of desperation.
Which is a huge shift from the pressure cooker of 2021. So that brings us to segment 3. The policy forces that are actively trying to reshape things.
And you see the government trying two things at once. A short-term fix and a much longer-term structural change.
The short-term fix is on the demand side, getting rid of the GST for eligible first-time buyers on new homes.
It's direct relief. It cuts a big upfront cost for a group that has really been struggling to get into the market.
But there's a catch.
There's a big catch. It only applies to builder-delivered new homes. The vast majority of transactions happen in the resale market. So it helps a specific group for sure, but it doesn't really move the whole system.
So it's targeted. Now, the long game is where our sources spend a lot of time. Development charges. Why are these local fees so important?
Because they are a fundamental choke point for creating new supply. The documents we saw said these fees have reached, and I'm quoting, unbelievable levels in places like the GTA.
And these aren't just small fees. This is how cities pay for everything, right?
All right.
Roads, sewers, transit.
Exactly. For a growing city, giving up development charges is like losing a huge chunk of your operating budget. It's a massive revenue stream.
And now Ottawa is stepping in, tying federal housing funds to commitments from the provinces to get those charges down.
It's a very blunt instrument. They're basically using federal money to force local governments to build faster and cheaper. One source even called it fiscal blackmail.
Wow. So there must be some serious political friction there.
Oh, the friction is intense. And this kind of change takes years, not months. Municipalities have to change their bylaws. Developers have to redo their financing. It's a slow, grinding process. It won't change things for 2026, but it lays the groundwork for years down the line.
Okay. The long game versus the short fix. That brings us to our final segment, the path forward. What does CREA's outlook say about how all this plays out?
Well, CREA's view is that interest rates are now approaching what they call stimulative territory.
Meaning just low enough to get people thinking again.
Just enough to pull those hesitant buyers back into the conversation, but, and this is the key, not low enough to unleash unchecked demand. We're not going back to bidding wars and huge price spikes.
So the question isn't if buyers will return, it's about the scale of their return.
That is precisely it. And that scale depends entirely on how these policy changes, and especially the job market, all intersect. If job stability doesn't improve, the market stays measured.
So if we had to give a final forecast for the spring selling season, not a boom, not a bust, what does it look like?
Based on everything we're seeing, the stable inventory, the return of that necessary end-user demand, the consensus is that the market will advance with restraint.
Restraint, not excitement.
It'll be a measured, steady recovery, not a wild stampede.
That seems to capture the complexity perfectly. This has been incredibly insightful.
It's a complex time.
So the key insight for you, the listener, is that the Canadian housing market is oscillating inside this narrow, stable band that often comes before a real turning point. It's being driven less by speculative hope and more by real family needs, combined with these complex policy moves on GST and, crucially, development fees.
And that leads us to the final provocative thought. The biggest long-term change we've talked about is Ottawa tying federal money to cutting those development charges. It's meant to create a more efficient supply chain, which we desperately need. But the question for you to consider is this: how challenging, politically and financially, will it be for municipalities to give up one of their most lucrative revenue sources? Will federal pressure actually be enough to overcome the local budget holes this is going to create? That's a political negotiation that will directly impact your property tax bill for years to come.
A sum to ponder as we all watch those city budgets. Thank you for joining us for this deep